Welcome back in. Well, certainly you know a lot of folks have been struggling financially during this pandemic, but there is a silver lining for those of you who are looking to buy a home. Lenders are dropping borrowing costs in things such as home mortgages, but there is a catch, and that's what we want to talk to you about now. Marshall Clay from the Wells Group joins us this morning by FaceTime to talk about some strict new lending standards. Good morning, Marshall. How you doing?
Morning, Mike. How are you?
I'm doing okay. I can't complain. But yeah, rates we know have been low now, and so for folks who are looking to borrow it, that's a good thing. But so what are some things we need to watch out for, though?
Yeah, so banks are really struggling like everybody else. I mean, there's a lot of underlying economic uncertainty out there, and so while those borrowing costs have been going down, the hurdle in which people have had to get over in order to access those low borrowing costs has been raised. And so there's a couple of things to consider. One, if you already own a home and you potentially need access to cash in the not too distant future, and you actually have a home equity line of credit, I would encourage all of your viewers to hold on to that home equity line of credit. There's a lot of banking institutions out there that aren't even issuing new home equity lines of credit. So if you've got one, you really want to hold on to it.
Okay.
Second thing I would recommend is, start planning now. With one of the big things that they've done is a lot of banks are requiring now that you put 20% money down on your home. And so that's a little bit of a change. In the past, you've been able to access, capital with only, 5 or 6% down. And that's still the case under some programs. But I would expect as a borrower to have to put 20% down if you're looking to buy a home in the not too distant future.
Yeah, because a lot of these institutions are trying to protect themselves because they don't know what's going to happen with people in terms of their careers and jobs and that sort of thing, and financial ability. So what about your credit score? Is it improving it a simple task, and how do you protect it?
Well, I mean, to some, it's not. I mean, if you've developed bad habits over the years, it can be hard to dig out of that hole. But there's a couple of things, small things that you can do. One, pay your credit card bills on time. I mean, that's one of the easiest ways that these, credit report agencies can assess your credit. So paying those credit cards off on time is very important. Obviously, doing an annual credit score review, or at least annually. I mean, I check mine almost weekly. Just to make sure that there's nothing funny going on, but at least annually you want to check that credit score. Annualcreditreport.com is a great place to go. Equifax Boost is another program that's out there that gives people credit for paying utility bills and phone bills, which people typically pay, that boost that credit score. And then also, just making sure that you're not accessing or trying to access credit unnecessarily. If you need credit, obviously go out there and look for it, but
don't apply it for it unless it's an extreme emergency. And also, just real quickly, we've got to wrap up. Keep unused credit cards if they're not costing you money, right?
Yeah, okay. So very, very, very counterintuitive there. One of the things that they use is this credit utilization ratio, and what that is essentially they look at how much credit you have and how much you utilize that credit. So the more credit that you're actually utilizing, that can actually hurt your credit score. So if you have an unused credit score or credit card that you're not tapping into, holding on to it is actually a good thing.
All right, Marshall Clay with the Wells Group. Appreciate the info this morning.
All right, thanks, Mike.